You want to get started investing in shares that are listed on the Australian Stock Exchange, but have no idea where to start? Well, in today's video, I'm going to be providing you with a complete step-by-step guide on how to invest in shares in Australia. You might have saved up some money now during this whole pandemic and you're thinking about investing some of it. Well, for a lot of young people in particular, investing is now becoming extremely popular. And it's estimated that millennials now account for about 10% of trading accounts that are opened by financial advisors, which is almost triple the number back in November 2019. Now, I personally think investing in shares is such a great opportunity for young people to get ahead financially because you don't actually need that much money to start investing in the first place. Like if you wanted to buy shares on Commsec, the minimum amount that you would need to invest is only $500. And it's not like you have to save up $100,000 to buy an investment property. But a lot of young people don't really understand how the stock market works or what the stock market even really is for that matter. So in today's video, I'm going to be covering the complete step-by-step guide on how you can invest in shares in the Australian Stock Exchange. So to get started, I want to talk about why people invest and the whole point of investing itself. When you go to work every single day, the whole point of working is so that you can make money. But we can't work for our entire lives because once we get to about the age of 60, our ability to actually do work starts to decline. But how can you retire if you stop working and stop bringing in that income and therefore don't have enough money to pay bills? Well, the way this is done is by saving and investing your money throughout your entire working career to the point where your savings and your investments are enough to supply you with an unlimited amount of money that you are able to live off and therefore don't need to rely on a full-time job for a source of income. And this is why people throughout their working lives save the money that they earn from their employment income. And instead of spending that money, they instead invest it in either shares or property. Now, to understand why people buy shares, I'll give you an example first of property to make things clear. When you typically buy property in Australia, you do so by paying about 10 to 20% of the value of that property down in cash as a deposit. And then you borrow the remaining funds for that property from the bank as a mortgage. As you pay off that mortgage over a 30-year period, the value of that property will go up in value as well. And in Australia, property has increased by an average of about 10% per year over the last 20 to 30 years. By the time you've paid off your mortgage and you go to sell your property, you'll be able to sell it at an amount that's much, much higher than what you originally paid for it. And this is the core concept of investing. Saving money, using that saved money to buy something, holding that something for a significant period of time, and then selling it at a higher price than what you paid for it. The whole point of investing is to ensure that any amount of money that you've saved up actually increases in value over time and doesn't become a victim of inflation. Inflation is just when the price of goods and services just gradually goes up over a period of many years. Like I remember the days when if you wanted to buy a coffee, you'd only have to pay $3, whereas nowadays you've got to pay $5. Investing is also important because it gives people an incentive to actually save their money. If you invested $100 and made a 10% return after 1 year, your investment would then be worth $110, meaning that you made $10 profit on your investment. However, if you instead invested $10,000 and also made that same 10% return after 12 months, you would instead have $11,000, making a total of $1,000 profit on your investment. Whereas if you don't do anything with that money and instead just leave it in a savings account, then it's actually likely to decrease in value due to inflation by about 2 to 3% per year. But you can really see the power of this because let's say now instead of $10,000, let's say you invested $1 million and you're still making that average 10% return per year, then you would be making $100,000 per year, which for a lot of people is the equivalent of a full-time salary and something that they could easily live off. And making this kind of return in the Australian share market is actually pretty feasible. When you look at the average annual rate of return of the top 200 companies that are listed on the Australian Stock Exchange, you'll see that the average annual returns are about 9% per year. So what exactly are shares? Well, when you buy shares that are listed on the Australian Stock Exchange, you're actually buying into a business. There are many businesses that are listed on the Australian Stock Exchange that you can buy shares in, like for example, Commonwealth Bank, ANZ, Woolworths, and BHP. And the reason why you can buy shares in these companies is because they are publicly listed. This just basically means that anyone can invest in these businesses if they want to. And a share simply means that you own a part of that business. But buying a share and therefore owning part of that business doesn't necessarily mean you're responsible for managing the day-to-day operations of that business. It's not like if you owned a clothing store or a restaurant and therefore had to manage the day-to-day operations of that business itself. But it does mean that you do get to have some say in terms of the overall management of that particular business and how it should be run, including who should be the CEO and the strategy and direction that the company needs to take in order to increase the value of the business in the future. So you're not necessarily managing the business, you just have an ownership stake in it. And if you owned all the shares of a company, then you would effectively own the entire company itself. For example, Commonwealth Bank has about 1.7 billion shares that are available to be bought, and a single share is worth about $100. So you would have to pay about $177 billion if you wanted to buy every single share in Commonwealth Bank and effectively own the business itself. Obviously, no one has that much money to buy out Commonwealth Bank, which is why with shares, you only own a very, very small amount of Commonwealth Bank if you decide to buy shares in CBA that are listed on the ASX. So say, for example, if you bought 10,000 shares in Commonwealth Bank, you would own a very, very small amount of CBA, which is equivalent to less than 1% of the total business of CBA itself. But like I said earlier, you're not actually responsible for the day-to-day operations of the business itself. But you do get some say in terms of who the board of directors need to be and the strategic direction of the company, depending on how many shares you own. Although in almost all cases, the amount of influence that you would have in these sorts of decisions would be very, very, very minimal, because the amount of actual shares that you can buy in CBA would be very, very small in comparison to other people owning shares in CBA as well. But regardless, you're still owning a small part of that business and therefore get to make money from that business as a result. You can't buy shares in businesses that are not listed on the ASX. If you wanted to invest in a business that wasn't listed on the ASX, you just simply wouldn't be able to buy shares. You would most likely instead need to invest in that business privately. There are two ways that you can make money from buying shares listed on the ASX. The first is through dividends and the second is through capital appreciation. So what are dividends? Well, every year, a company that's listed on the ASX makes money. For example, Woolworths will make money from its customers buying its groceries. It then uses that money to pay for its business expenses, like the cost of food from its suppliers, paying its workers, and the rent for the stores as well. Once it's paid for all of that, it's still then left over with some money, and that's referred to as profit. The CEO and the board of the company then make a decision on what they should do with that profit. And some of that profit therefore goes back to the investors of Woolworths who own shares in that company. As a reward to their investors, Woolworths will pay a cash payment to their investors, and this is called a dividend. So dividends are one way that you can make money from shares, because it's a company's way of paying out some of their profits to its investors and therefore rewarding them for investing and believing in their company. Dividends, for the most part in Australia, are paid out twice a year, and the dividend money is paid directly into your trading bank account. And a trading bank account is something that gets created when you go to create a brokerage account that you can then use to buy and sell shares in Australia. Not all companies listed on the ASX pay a dividend though, and the amount of money that companies pay in dividends to their investors will vary. The amount of dividends that you get paid as an investor is always going to be proportional to the amount of shares that you own. So for example, if you just owned one share of CBA, which is worth about $100, then you would have received $2 paid into your bank account as a dividend in September this year. Now, the amount of the dividend that companies pay to their investors relative to the share price is referred to as a dividend ratio or dividend yield. The dividend ratio of CBA is about 3.5%, meaning that if you had invested about $1,000 in CBA, you would make about $34 per year in dividends. Whereas other companies could pay a different amount of dividends, and again, that's dependent on how many shares that you buy. The second way that you can make money by buying shares in Australia is through capital gains, which just simply means that the price of the share increases over time to an amount that's greater than what you had originally paid for it. You can then sell that share in the future and make a profit on it. Value of shares is typically determined by how much the company is worth. And companies have an obligation to their shareholders to increase the value of their business over time. And the way that they typically do this is by taking a proportion of their profits and reinvesting it back into the business each and every year in order to grow that business. For example, every year, Woolworths could look to buy more stores, invest in new products, and improve their store layout in order to drive more customers and therefore buy more groceries from their stores. The aim of doing this is for Woolworths to be able to make even more money in the next year than what they did on the previous year. So by reinvesting that money back into the business, the profits of that business are likely to grow over the years, which in turn means that the value of their business and their shares also increases over time as well. So because the business is now making more profit in the future, not only does the value of their business increase, but so too does the amount of money that people are willing to pay for the shares in that business. So since people are willing to buy those shares for a larger amount of money than the price that you had originally paid for them, you now sell your shares at that market price and make a profit on your investment. So if you had purchased Woolworths shares in July of 2016, you would have paid about $17 per share. And if you had sold those shares in August of 2021, you would have sold them for about $40 per share, making you a profit of about $23 per share. And that's just for one share. If you had invested $10,000 back in that time, you would have purchased 588 shares worth $17 each. When you sold those 588 shares for $40 each in August of 2021, you would have sold them for about $23,000, meaning that your total profit on that investment is about $13,000. Difference between what you sell those shares for and what you buy those shares at is always referred to as profit or capital gains, which in this case would be about $13,000. You can also sell those shares though for a loss, and that's referred to as capital losses. Now that you know the two ways that you can make money from buying shares in Australia, you really just now need to get started investing. Firstly, you'll need some cash set aside, and secondly, you'll need a brokerage account. Obviously, any amount of cash that you're thinking about investing into the ASX needs to be an amount of money that you're comfortable with putting away for a significant period of time. Secondly, you'll need a brokerage account, which is just an account that gets created when you want to buy and sell shares that are listed on the ASX. You can check out my other video here, which gives you a full breakdown of lots of different trading accounts in Australia and the cheapest brokerage account that exists as well. Investing in shares in Australia also carries significant tax issues as well. If you sell your shares within 12 months of buying them, all of the profit that you make on that trade is taxed on top of your salary for that year. So for example, if you make $100,000 as a base salary and you sell those shares within 12 months, making a $20,000 profit, you'll then be taxed $120,000 for the full financial year. If you hold those shares for longer than 12 months, then you're only taxed on 50% of the profits that you make on a trade. So in this case, you would only be taxed $10,000 or $110,000 for the full financial year. Paying taxes on shares does have significant implications on your investment returns. So it's really important that you speak with a licensed tax professional. Now, the next thing to consider is having a think about what companies you want to invest in. I'm never going to give specific investment advice on what particular shares you should buy. But for me personally, I've always been a fan of ETFs because they allow me to buy a huge basket of stocks in a single trade. Investing in single stocks for me personally has meant that I've actually lost a lot of money. And I've got some other videos on my channel which show how I've lost thousands of dollars by buying individual stocks. In your investing journey, you will most likely come across the website The Motley Fool, which just basically has a whole bunch of articles about certain ASX companies and recommends whether you should buy them or not. Now, I've personally lost a lot of money because I've read articles on The Motley Fool that have previously advised buying certain companies. So for me personally, I'm never going to use this website again for investment advice. The other thing to remember is that investing is a long-term strategy, something that's likely only going to make you money over a period of at least 5 to 10 years, certainly not within 12 months. So buying individual stocks with the hope of tripling your money within 12 months is just not a great idea in my opinion. Most people who write these articles on The Motley Fool as well own shares in the companies that they're promoting on the website itself. And so they have a financial incentive for other people to buy those shares because it's therefore likely to cause an increase in the share price itself. Meaning that the people who originally write those articles and therefore own those shares can sell those shares at a profit when the price of those shares go up, as other people who read those articles buy those shares as well. If you're interested in learning more about investing and building long-term wealth, then check out my other videos on my YouTube channel as well, which is all about obtaining financial independence.